I lived through stagflation, the decade of the 70s. So did Mr. Diamond, and it is certainly no picnic. I am hopeful, although I'm not an economist, that the vestiges of globalization, the fact that we have the continued relative strength in the Chinese economy and in emerging markets economies, and the fact that our economies now are more reliant on technology relative to capital than they used to be, that we can escape stagflation. I think inflation is inevitable, absolutely positively inevitable. I think a slowdown in the economy is likely, but I'm less certain about that. I hope with every fiber of my being that what Mr. Diamond suggests does not come to pass. The period of the 1970s, while it was not unpleasant for me, I was involved in gold and natural resources, was extremely unpleasant for most people. And my hope is that people can avoid that sort of decade. I think the biggest issue that's in front of us isn't addressed by either party or either candidate. That is the excessive size of the government relative to the size of the economy, and I'm talking in the US context now, the incredible size of our debt. It would be useful for your listeners to understand that the on-balance sheet liabilities of the US government are by now almost $36 trillion. But the off-balance sheet liabilities of the US government are greater. Off-balance sheet liabilities mean mostly the net present value of entitlements, Medicare, Medicaid, Social Security, that kind of thing. That number in the US context is now, according to the Congressional Budget Office, about $100 trillion. So the net present value of off-balance sheet liabilities added back to the on-balance sheet liabilities is, by the government's estimate, about $135 trillion. Interestingly, net private wealth in the United States is estimated by the Fed at $139 trillion. So the on-balance sheet liabilities and the off-balance sheet liabilities of the US government come within $5 trillion of the private wealth of American citizens combined. We're dealing with these debts with a budget that's in deficit $2 trillion a year. Neither candidate has mentioned that. Neither candidate has mentioned the fact that this debt is non-viable. I unfortunately know how we work this out. You maintain the nominal entitlement around Medicare, Medicaid, Social Security, that kind of thing, but you inflate away the net present value of the obligation. In other words, some old geezer named Rick Rule, who has been promised $2,500 a month in Social Security, gets it, and he gets it for the next 10 years, but $2,500 buys $400 worth of goods and services. That's what we did in the decade of the 70s. According to the US government, in the decade of the 1970s, in 10 years, we inflated away 75% of the purchasing power of the US dollar. And my belief is in the next 10 years, we repeat that trick. I am in contact with very low-level employees of the Federal Reserve. And the Fed as an organization believes that they are the only thing that stands between us and the rampant deterioration in the purchasing power of the US dollar. There's a bias within the Fed to keep interest rates higher. The political reality at the top of the Fed is that they can't do it. And it will really depend on the state of the bond market, the state of the equities market, and employment stats. If they are able to withstand the pressure to cut the interest rate, the Fed as an organization wouldn't cut it. Whether or not they have the political capability of not having a rate cut is a very, very different question. both candidates have talked about having more political control over the Fed, which is to say both candidates, both parties, would like to see the nominal interest rate lower. We saw that in the middle part of the decade of the 70s. The interest rate in the period 1970 to the end of 1974 went gradually higher as savers demanded more compensation for inflation.
Yes.
The Fed was accommodative to the market. In 1975, there was political pressure to cut the interest rate. They did. They basically lost their nerve as the higher interest rate led to stagnation in housing. But in 1975, when the Fed capitulated, when they cut the interest rate, it was very. When they raised the interest rate, the gold price fell in half, but it obliterated the bond market, it obliterated the stock market, and they lost their nerve and had, some artificial cuts again. My suspicion is that if we had, and I don't want to be an alarmist, I want to say we're going to do this, but if we had a circumstance like 2008, if we had some form of liquidity crisis, I think that the only defense that the political class has to them is artificially low interest rates and probably quantitative easing. If you saw that happen, that would announce to the market that the government had capitulated, that they don't care about the strength of the dollar, and they don't care about long-term solvency. All they care about is the election cycle. Mm-hmm. The policy response is always inflationary.
I see.
The difference, David, between now and 2008 is in the 2008 collapse, if my memory serves me well, the on-balance sheet liabilities of the U.S. government, what is commonly called the government debt, stood at about 45% of GDP. Today, that same number is 110% of GDP, which is to say that we have less policy options now than we had then, as a consequence of the aggregate level of indebtedness. Well, we've seen this before. Gold broke out in non-US dollar terms 4 or 5 years ago. It hit nominal all-time highs against most currencies 4 or 5 years ago. It's coming around to the US dollar. So even as the US dollar outcompetes even weaker currencies, gold is beginning to outcompete the US dollar. And I think that that's simply because some savers, pension funds, endowments, and the like, understand that the real versus the nominal interest rate in the US is negative. If I'm right, and the deterioration of the purchasing power of a basket of goods and services denominated in US dollars, put differently, if the real deterioration of the purchasing power of the US dollar is actually, as I believe, about 7.5%, and you're getting paid 4.4 on a US 10-year treasury, rather than actually getting 4.4, you're losing 3.1 in purchasing power. In other words, the US government solemnly swears that they will reduce your purchasing power by 3% a year compounded for 10 years. Not a very good deal. The consequence of that is that you're seeing disintermediation out of US treasuries and into other instruments, including gold. I really don't think it is. I think that the market is discounting a Trump win. I think both candidates are bad for the US economy long term. I think
because they'll add more debt, because they're adding.
Exactly.
Okay.
They aren't dealing with any economic issues. What the candidates are doing is trying to bribe various voter classes by promising to lavish money on them.
Right.
I think that the financial class sees less threat to themselves with Trump than with Biden. I think whoever wins the election, there's going to be an awful lot of discomfort around different segments of the U.S. Electorate. I think, as I say, a Trump election in the near term would probably be good for equities markets and probably good for the financial services sector. Um, I think that the financial class would greet a Harris election the same way they greeted the Clinton election, which is to say extremely unfavorably. How long that would last is a different question. They're fairly adaptable folk.
The US economy faces mounting debt, inflation, and limited policy options, echoing the stagflation of the 1970s. With $135 trillion in liabilities and disintermediation from US treasuries into gold, the financial class is bracing for challenges ahead, regardless of election outcomes. Gold is emerging as a key hedge against declining purchasing power. Now you know the truth about America's economic challenges and how gold is taking center stage. But there's more you need to understand. Click on this video to uncover the next critical development. Don't forget to like, comment, and subscribe for more insights. See you there.